Hello there. So today is March 1st, which means tomorrow is the RRSP contribution deadline for 2019. But what does that mean? Well, so we can contribute to our RRSPs and have them impact a specific tax year. If we contribute within the calendar year, then obviously it can be attributed to or can impact our tax year or taxes for that current year. But also, we can contribute to our RRSPs from January 1st to the first business day in March, and they can count towards our prior year. So tomorrow is the last day that you can contribute to your RRSPs for 2019. That is a pretty common thing that people know. The banks do a really good job of pushing that out to everybody because they obviously want to sell more RRSPs right at the end of, well, just in general. They really just want to sell more in general. So they push that out to everybody. Contribute to your RRSPs, you can save money on taxes, blah, blah, blah. But what does that really mean? How do RRSPs impact your taxes? Why do we contribute to them? So the general idea of RRSPs it stands for Registered Retirement Savings Plan. So the government is trying to encourage people to save for their retirement by giving them a tax break now for doing that. So if you put money into your RRSP, then every dollar that you put in directly reduces your income in the current year by $1. So if you had $100,000 in income, you contributed $10,000 to your RRSP, then your income effectively is $90,000 for tax purposes. I mean, that's a really simplified way of looking at it, but that's what happens basically. So in that way, it saves tax in the current year because you're not taxed on that $10,000 or whatever it is that you've contributed. You will be taxed when you pull that money out of your RRSPs later, like when you retire. The idea there is that we, in our working years, are taxed at a much higher rate than we will be when we retire. So if you're making $100,000, then your effective tax rate is going to be much higher than if you're making, I don't know, $50,000 in retirement. So you'll save taxes by the difference in those two rates. Let's look at an example. So if we contribute $10,000 and our effective tax rate right now is 30%, then that means we would have paid $3,000 in taxes on that $10,000 that we contributed. But say we put it into our RRSP, we save the tax on it now, and then later on, when we retire, we pull that money back out. So we pull out $10,000, and our effective tax rate now is only, say, 20%. So now we owe $2,000 on that money that we've pulled out, but we've actually saved $1,000 because we would have paid $3,000 had we not contributed to the RRSP in the first place. That's the general idea. Obviously, there's a lot of other factors that you want to think about when you're contributing to your RRSPs. If you're in the lowest tax bracket right now, maybe it doesn't make sense to contribute to an RRSP because when you pull it out later, you're not going to actually have saved any money in taxes. You've just deferred the tax. And it may be worth it to contribute to a TFSA instead, because although you had to pay tax on it in the current year, the growth that you saw in the investment from today to when you retired would be tax-free in a TFSA. As we start to get into investing stuff, I am not a financial planner, so I can't speak to investing and what the best way to go about doing that is. I can really only speak to the tax impacts that your choices will have. So RRSPs directly reduce your income in the year that you contribute, and that will save you money in taxes in the current year. That's usually what generates the refund. So you've had income taxes taken off your paycheck based on the amount of money that you actually paid, obviously. And then when you contribute a bunch of money to your RRSPs, then you get back the tax you would have owed on that money. TFSAs do not impact your taxes in the year that you contribute. In fact, they actually have no impact on your taxes at all. Hence tax-free savings account. But what they do allow you to do is just save money on any growth that you have within that account because it's not taxable. Whereas if it was unregistered, you would have to pay taxes on, capital gains or dividends or whatever it was that you were getting from that investment. So if you are in a higher tax bracket and you have some cash laying around, it might be worth it to contribute to your RRSP. I definitely recommend speaking to a financial planner about this kind of thing because they can help you with your specific situation and your overall portfolio and the balance and all that stuff that I just don't know about. But certainly from a tax perspective, you will save money this year if you contribute to your RRSPs. If you want to talk about your taxes, I'd love to chat with you about it. I can do a free 30 minutes. I say this every day. Book free 30 minutes with me. I'd love to chat with you about your taxes. I left the link in the description there. chat.kirkcpa.ca/call. Like I said, not a financial planner, but I am good at taxes. So let's talk about that. I'll see you tomorrow.